Last night saw a sudden crash in the US equity market kept many investors wide awake. Countless messages came in asking the same quest: if the US government's shutdown crisis has been resolved, why did the market collapse instead of stabilize? Is this decline a buying opportunity or the beginning of a burst bot? Why did tech stocks get hit so hard? Was it panic? Selling from retail trades? Where does the market go from here? Is there still a year-end rally coming? And what should regular investors do now? These are legitimate questions that deserve thoughtful answers, because what we are witnessing is not short-term volatility driven by headlines. It's the start of a deep structural adjustment. Today, I want to walk you through what really happened, step by step, so you understand the underlying mechanism rather than reacting emotionally. Why the market crashed so suddenly on the surface. Reopening the government looks like positive news, but in reality, the most critical economic data still has not been released. The key inflation report, CPI, was delayed with no confirmed publication date. In financial markets, bad news is the most threatening scenario. Uncertainty is investors can price in negative data, but they cannot price in the unknown. When the anchor of valuation disappears, markets search for consensus through price discovery, and that process usually comes through rapid volatility. At the same time, nearly every major voice in the market yesterday focused on rising inflation risks and increasing concerns about stagnant economic growth. More importantly, multiple Federal Reserve regional presidents came out with hawkish commentary on the same day, directly attacking the foundation of the earlier expectation for a December rate cut. The probability of a December cut dropped sharply below 50%. Policy expectation shifts don't require actual data. The repricing happens the moment sentiment breaks. That is exactly what triggered last night. Bear sharp sell-off. This was not an accident. It was a systemic repricing event driven by accumulated uncertainty. Rate 2. Why tech stocks fell the hardest. For many investors, the most shocking part of the sell-off was the tech sector collapse. Over the past several quarters, tech stocks have carried the majority of the market's gains and captured the largest optimism premium. Many assumed a wave of retail panic selling triggered the decline, but that is not true. The real driver was institutional repush. Why institutions and not retail? Because of timing. Most institutions have already achieved their performance targets for the first 3 quarters. Traders' compensation and bonuses are essentially locked in. At this point in the year, success is no longer about earning more. It's about protecting what's already been earned. No one wants to take excessive risk heading into year-end. No one wants their performance wiped out in the final stretch. So large funds began reducing exposure to high valuation, high volatility positions with heavy concentrations, and that definition describes the tech sector perfectly. This is not about losing faith in technology. It's about risk management and profit preservation. It is a strategic shift, not a judgment about long-term fundamentals. Looking at history, technology is not always the leader. In decades of market data, November and December are often the strongest rebound period for lagging sectors. Energy, consumer staples, and utilities traditionally outperform growth. That is structural behavior driven by seasonal rotation, performance, locking, and portfolio rebalancing. So this tech sell-off is not a collapse. It is the beginning of a rebalancing cycle. Part 3. Why sentiment reversed overnight. Market psychology can swing fast, but the forces behind it build gradually. The perfect storm came from delayed economic data, a sudden shift in policy expectations, and extremely crowded institutional positioning, all converging at the same time. This crash was not a trend failure. It was a structural repricing event. One idea is crucial to remember. Major trend reversals rarely occur at the very top. They occur when consensus reaches subprance. Tech positioning had been overcrowded for months. It only needed a catalyst. Yesterday was that catalyst. Part 4. What determines where the market goes next? The market's next move will not be determined by government actions or political headlines. It will be determined by earnings, specifically NVDA, your upcoming report. NVDA is the valuation anchor of the entire AI ecosystem and a central asset for institutional holdings in the technology space. It is both a pressure test and an emotional pivot point for the broader market. If NVDA beats expectations, the valuation structure of the tech sector can stabilize, and sentiment will recover sharply. If it disappoints, uncertainty around profit expectations will intensify, rebalancing will accelerate, and capital will flow even faster toward defensive sectors like energy, consumer staples, and new curves. The market is not waiting for reassurance, it is waiting for an anchor. That is the real inflection point. Part 5. Is there still a chance for a year-end rally? According to the latest outlook from Wells Fargo, a year-end rally could be driven by 3 pillars. First, fiscal and tax stimulus effects that are scheduled to be realized before year-end may provide liquidity support. Second, strong earnings, guidance from major corporates, and a potential pivot toward rate cuts could stabilize valuation multiples. Third, seasonal portfolio positioning. Historical data shows that lagging sectors regularly outperform in the fourth quarter, driven by institutional rebalancing from a broader perspective. The fourth quarter is rarely dominated by technology, rather it is typically a transition from growth to stability and value. Part 6. What regular investors should do now? The key is not predicting the market, but managing behavior and decision quotient. Do not react emotionally at the worst moment. This is structural adjustment, not collapse. Do not aggressively buy tech before NVDA earnings. That is a low probability. Gamble, focus on rotation instead of themes. Energy, consumer staples, and utilities may offer real opportunities. Maintain healthy cash reserves. The best opportunities appear when forced selling exhausts itself. Accept market rhythm shifts rather than resisting them. The most dangerous thing now is confusing volatility. Final conclusion. Last night's yen crash was not the start of a breakdown. It was an institutional rebalancing event, part of profit protection and year-end positioning. The tech sector is not dead, it is undergoing valuation normalization. The real direction signal has not yet appeared. It will come after NVDA results. Before earnings is a risk window, after earnings is an opportunity window, and the leadership of the coming rally is unlikely to be technology. It will come from value and defenses if you believe in independent thinking and want to understand markets through structure rather than emotion. I invite you to continue this journey with me. Subscribe to the channel if you find value in thoughtful analysis rather than noise or hype. Not because I can promise quick profits, but because disciplined reasoning will always be the rarest asset in a volatile world. I'm Stock Captain Lady, and I will see you in the next episode.